The LLC S Corporation election might be one of the most powerful tax strategies for small business owners. This hybrid business structure combines the operational flexibility of an LLC with the tax advantages of an S corporation, potentially saving thousands in self-employment taxes. Limited liability companies and S corporations represent two of the most popular business structures today. Rather than choosing between them, many business owners are discovering they can have the best of both worlds by forming an LLC and electing to have it taxed as an S corporation. Let's start by understanding what makes each entity unique. An LLC provides limited liability protection, shielding your personal assets from business debts and liabilities. It offers operational flexibility with minimal formalities and pass-through taxation, meaning profits flow directly to your personal tax return without corporate-level taxes. For federal tax purposes, a single-member LLC is treated as a sole proprietorship, while multi-member LLCs are taxed as partnerships. In both cases, owners report business income on their personal returns and pay self-employment taxes on all profits at a rate of 15.3%. S corporations also provide limited liability protection and pass-through taxation, but with a significant difference in how owner-employees are taxed. S corp owners can pay themselves a reasonable salary and take additional profits as distributions, which aren't subject to self-employment taxes. The ownership structures also differ considerably. LLCs can have unlimited members, including corporations and foreign entities. S corporations are restricted to 100 shareholders, all of whom must be United States citizens or residents. Additionally, S Corp must have only one class of stock, while LLCs can create various ownership classes with different profit-sharing arrangements. To elect S corporation status for your LLC, you must first ensure your business meets the eligibility requirements. Your company must be a domestic business entity, have no more than 100 shareholders, and those shareholders cannot include partnerships, corporations, or non-resident aliens. The election process involves filing IRS Form 2553, election by a small business corporation. This form must be signed by all members and submitted to the IRS. Timing is important. You must file within 2 months and 15 days from the beginning of the tax year you want the election to take effect. The primary benefit driving most LLC owners to elect S Corp status is tax savings. Here's how it works. Instead of paying self-employment taxes on all business profits, S Corp owner employees pay payroll taxes only on their salary. The remaining profits can be taken as distributions, which aren't subject to the 15.3% self-employment tax. For example, if your business nets $100,000 and you pay yourself a reasonable salary of $60,000, only the $60,000 would be subject to payroll taxes. The remaining $40,000 could be taken as distributions, potentially saving over $6,000 in self-employment taxes. Beyond tax savings, the S Corp election can enhance your business's credibility and make it easier to raise capital from individual investors. The structure also provides a clear separation between your role as an employee and your position as an owner. However, this election isn't without drawbacks. S Corp face stricter compliance requirements than standard LLCs. You'll need to issue stock, potentially adopt bylaws, maintain more formal records, and hold regular meetings with minutes. The IRS also scrutinizes S Corp closely, particularly regarding owner compensation. You must pay yourself a reasonable salary based on industry standards, experience, and duties performed. Setting your salary too low to maximize tax-free distributions can trigger an audit. Additionally, the ownership restrictions may limit your growth options. You cannot have foreign shareholders, more than 100 owners, or multiple classes of stock with different rights to profits and distributions. LLC S Corp status works best for profitable businesses with stable income and owner employees who actively participate in the business. If your LLC is consistently profitable and generating more income than you need for reasonable living expenses, the tax savings from an S Corp election could be substantial. Conversely, if your business is in its early stages and experiencing losses, a standard LLC might be preferable, as those losses can flow directly to your personal return without restrictions. Similarly, if you plan to reinvest most profits back into the business or anticipate bringing in foreign investors, the standard LLC structure offers more flexibility. The LLC with S Corporation election represents a strategic middle ground for many small business owners. It combines liability protection with potential tax savings while maintaining much of the flexibility that makes LLCs attractive. However, the additional compliance requirements and ownership restrictions mean this hybrid approach isn't right for every business. Before making this election, consult with qualified legal and tax professionals who can analyze your specific situation and help determine if the long-term benefits outweigh the added responsibilities. With proper planning and compliance, an LLC taxed as an S corporation can be an effective tool for building and growing your business while optimizing your tax position.